This is Asia Trade. I'm Shery in Tokyo.
I'm Haidi, Stroud-Watts in Sydney. The top stories this hour. Asian stocks are set for a cautious open ahead of the Federal Reserve's policy decision. The S&P 500 snapping a six-day winning streak while Treasuries rally. The FOMC expected to keep rates on hold despite pressure from President Trump for a cut, with investors watching for the September outlook and any dissenting votes. Plus, trade still top of mind. The US and China set to continue talks over extending their trade truce, with Trump to make the final call.
This is a setup across Asia. We're following, of course, those trade conversations, especially between South Korea and the United States. We heard that officials met with Commerce Secretary Lutnick in the U.S. We're also following, of course, the markets, with the Nikkei futures pointing to the upside of 0.2%. After 3 sessions of losses already, Asian stocks were under pressure this week. We have seen the Japanese yen sort of range bound around that 148 level, but the JGB market is one to watch, given that we had a solid 2-year auction. Really, investors attracted to that higher yields. We're talking about levels that we haven't seen since 2008. All of this ahead of the Bank of Japan policy decision. No change expected this week. No change expected from the Federal Reserve either. Take a look at how U.S. futures are setting up. We fell a little bit from those record highs after 6 sessions of gains already. Perhaps not surprising, given that we do have a lot of risk scenarios going forward. We have big tech earnings, not to mention, of course, the Treasury announcement of quarterly refunding. So we could see a little bit more volatility. Not surprising, we saw that jump when it comes to Treasuries by the most in about a month. We also do have, of course, the Friday employment numbers and plenty of trade headlines to follow, Heidi, as we head into the last part of this week.
Already enough fundamental risk before you have that overlay when it comes to trade uncertainty, right? But there's plenty of that. Of course, we know that these talks between China and the US are continuing to potentially extend that trade détente. We had heard about reporting of perhaps another 90-day extension. Treasury Secretary Scott Bessent saying that they will be continuing those talks to maintain the truce before it expires in 2 weeks. But take a listen to what he had to say.
We don't want to decouple. We just need to de-risk with certain strategic industries, whether it's the rare earths, semiconductors, medicines, and we talked about what we could do together to get into balance within the relationships.
And despite the fact that, of course, we're seeing these trade deals and the tariffs are lower, Heidi, it is worth mentioning that the tariff rate right now in the United States is still 6 times the level when President Trump actually took office. So Bloomberg Economics now thinking that we could see a $2 trillion hit by the end of 2027. And the IMF coming out also with its latest projection, saying the global growth will decelerate to 3% growth in 2025 from 3.3% last year. Take a listen to what the IMF chief economist had to say.
Medium-term growth has been relatively weak in the recent years, and it's expected to continue being weak. We have much lower long-term, medium-term growth than we used to have, let's say, 10, 15 years ago. And so that's a concern here, is that the tariffs are actually going to add to that tepid, mediocre medium-term growth and may not necessarily be reverted anytime soon.
For more, let's bring in Bloomberg's chief economist, Tom Orlik, joining us from Washington. And Tom, we have seen still resilience when it comes to global growth, especially in the U.S. We get those second quarter numbers as well this week. What are we expecting in terms of how this will really affect the thinking from the Federal Reserve?
So for the Fed, Shery, I think there's a couple of big things going on. The first is the trade war. That puts them in a difficult position. They see tariffs risking higher inflation, so they want to hold or hike. But they also see tariffs hitting growth, so they want to cut. We think they're going to be paying more attention to the inflation risk, at least for the next few months. The second big thing, of course, is risks to Fed independence and all of those attacks on Chair Powell and his decision-making by President Trump and other members of the executive branch. Now, the Fed would tell us they don't pay any attention to politics, but they do certainly want to preserve their independence. And if it's a difficult call, well, the president telling them to cut actually makes it more difficult for them to cut, because that would raise questions about whether they're bowing to political influence. So we think certainly a hold this week. Consensus is drifting towards, or has drifted towards, a cut in September. We wonder if that's the right call. Our view is perhaps the Fed might be staying on hold all the way till December.
There's a politicisation angle, but there's also just the fundamental uncertainty when it comes to the trade landscape, right? How much does that impact what the Fed should or could do, depending on what happens with this China truce?
So we've got US-China talks taking place in Stockholm this week. Haidi, Treasury Secretary Bessent, USTR Greer, China's Vice Premier He Lifeng, continuing their tour of European cities, Geneva, London, and now Stockholm. The expectation, I think, is that they won't make progress on the big structural issues, but probably they'll keep tariffs on hold. Tariffs between the US and China around 40% right now. That's enough to take a really serious chunk out of US-China trade, but it's down from the embargo levels that we saw in that period of tit-for-tat retaliation back in April.
We're still expecting, of course, more trade deals to come out. We're hearing from President Trump that he could consider India's to come in at a 20 to 25% rate. When you look at the net levels of tariffs right now around the world, do you have any idea at this point what the global implications could be?
So I think the India story is pretty interesting, Shery. You remember before Trump won a second term, the narrative was very much about leaving China, moving to India, companies like Apple, other electronics firms, shifting their supply chains. India's turn to be the world's big exporter. Now, the US pivot against free trade is impacting China, but it's impacting India as well. And certainly if we get tariffs at those 20-25% levels, that's not going to be good news for President Modi and his ambitions to make India into the world's next manufacturing superpower. If we step back and think about the bigger picture, well, tariffs aren't the only thing happening right now. We also recently had the One Big Beautiful Bill signed. The CBO tells us that blows a hole in the US public finances of about $3.4 trillion over the next decade. Now, to fill that hole with tariff revenue, the US needs tariffs in the 15 to 20% range. So that's where we think things are going to settle. That's not going to be a complete disaster for the US and the global economy. It's not a recession level of tariffs, but certainly enough, it's high enough to be macro significant. Certainly it's enough to move the dial for the Federal Reserve.
At the same time, though, all of these trade deals, even as President Trump says, these are the biggest deals that he's made with the EU, with Japan, for example. They're very scant on the details, right? So how tricky is it in terms of any kind of economic projection, given how little we know?
So it's a great point, Heidi. I think there's a couple of things to think about. So the first thing is the tariff rates keep moving, right? Think about the tariff on China. In April, in that period of intense tit-for-tat retaliation, the tariff rate was above 100%. Now it's down to 40%. If these negotiations go well, conceivably it could come down a little bit more. Similar movements in tariff rates for other countries. If the tariff rate keeps moving, it's hard to predict what the impact is going to be. Second reason to take all of these kind of economic estimates with a grain of salt is, well, we just don't have any data on tariff hikes of this magnitude going all the way back to World War II. And if you don't have historical examples, it's pretty difficult to gauge what the impact is going to be. So the IMF's updating its forecast. We're updating our forecast. We all think tariffs are bad for growth. We all think tariffs push up inflation in the United States. Exactly how big are the impacts going to be? Well, I think Pierre at the IMF would tell you, and I would agree, that there's a pretty wide band of uncertainty around these forecasts.
Our chief economist at Bloomberg Economics there, Tom Orlick. There is, of course, more when it comes to this dissection of trade wars and tariffs coming up. UBS Global Wealth Management's chief economist tells us why the US trade balance is now at a key data point. We'll also be talking about how to invest strategically around these themes with principal asset management and taking a closer look at the tariff negotiations ahead of that Friday deadline with the Council on Foreign Relations. Take a look at some of the other geopolitical stories we're following this hour. And oil prices in focus after President Trump says he is giving Russia until August 8th to agree to a Ukraine ceasefire or face tariffs and possible secondary sanctions. Trump had originally set a 50-day deadline, which would have fallen in early September. He also says he's not concerned about oil market fallout because the US can ramp up its own energy production. UK Prime Minister Keir Starmer says Britain will recognise Palestine in September unless Israel agrees to a ceasefire with Hamas. He says Israel must also commit to a peace process that would result in a Palestinian state. The decision follows similar plans from France and signals a sharp diplomatic shift. Israel condemned the announcement, calling it a reward for terrorism.
And coming up on the Asia trade, Treasury yields drop as markets await the FOMC meeting, watching for possible dissenters to a likely decision to hold rates. A preview next. This is Bloomberg. Take a look at how U.S. futures are trading at the moment after we saw a little bit of pressure in the overnight session. Of course, we're coming off from record highs after 6 straight sessions of gains. It's a big week for earnings. More than 80% of companies on the S&P 500 have beaten profit forecasts. The dollar also strengthened for 4 consecutive sessions. But what we've been watching is really the Treasury space jumping by the most in about a month. We had a solid $44 billion sale, but also we're seeing them surging across maturities. Given investor anxiety, they're trying to lock in yields. Of course, we do have a busy day ahead. Treasury Department's refunding announcement, not to mention GDP data, and of course, the Fed's rate decision. A hold on rates is widely expected with the September outlook in focus. Traders will also be watching for any dissenting votes as Chair Jerome Powell faces relentless pressure from President Trump to lower borrowing costs. Christopher Condon leads Bloomberg's Fed coverage and joins us from Washington. Chris, so we're not necessarily expecting any change on the rates, so what should we be looking out for at this meeting?
You're right. There's not going to be a cut at this meeting. I think all the drama is going to be around whether or not the committee or the chairman signal a greater openness to cutting rates when they meet again in mid-September. So I think that's where all the drama is. We're going to look for that in the statement. There is a line on the labor market. If they're going to signal some new openness, it will probably come in their characterization of the labor market. They've called it solid since January. They might dial back that a little bit. That could be a signal. And of course, Powell has a great range in the press conference to provide any kind of message that he wishes to.
What about signaling? Do you expect something that points to action taken in September?
I would say I do not expect a strong signal, and here's why. Even if some of the committee are beginning to tilt closer to cutting in September, and I think there are some, even beyond the ones that are about to dissent tomorrow, there's a lot of time left, and there's a huge amount of data that will be coming in between now and the September meeting. And if you look at futures contracts, the market's already pricing in about a 65% probability of a rate cut in September. So Powell doesn't have to do a lot of work to get the market on side. And indeed, he probably doesn't want it to send a strong signal that sends those probabilities too high. He wants to preserve his options for September, and I think most of his colleagues also want to do that. So they'll play it pretty evenly, very even-handed, try to convince the market that there may indeed be a cut in September, but they also may yet hold again in September.
One of those voices that could advocate for that cut has been, of course, Christopher Waller, who's been very vocal about the need for the economy. So what are we seeing in the eco data that really makes him think that we should push for a cut now?
Well, there's two things. One thing that he's pointed to for quite a while, and that is his belief that the inflation impact from tariffs will be transitory. He does not believe that tariff-driven price increases will be persistent. He's very clear about that. More recently, he has expressed growing concern about the labor market. And he has pointed quite reasonably to the very weak numbers in private payrolls in the last jobs report that we got. The overall number was good, but private payrolls showed some real strain, and he's really jumped on that and based his argument for a cut now on that. Of course, in the background, it must be said that Chris Waller, it's no secret, would like to be the next Fed chair, and he is one of four names that's commonly mentioned under consideration by President Trump. And so people reasonably wonder if he is tilting a little bit that way. And I think it is safe to say that if he wants the job, he must dissent. But he also, to be fair, has made a very good argument for cutting. If not now, then soon.
But you get to a really key point here, right? Because especially for the markets, it's about expectations of where the Fed goes from here. And you have President Trump really attacking Chair Powell. If we continue to see these attacks and the expectation that perhaps Christopher Waller, who wants a cut, could become the next chair, what are the implications for the broader economy and how markets view the Fed's trajectory?
Well, the really massive question underneath all of this is whether the Fed as an institution can maintain its credibility in financial markets on price stability. I think as long as Jerome Powell is the chair, that will remain in place. But of course, his days as chair are numbered. And Trump has telegraphed very clearly that he wants to pick someone who is ready to cut rates. So the next chair will have to prove themselves to markets as after their appointment as independent from Trump. And if they struggle to do that, that could cause an increase in inflation expectations, which could be very corrosive in the longer run. It wouldn't have a very quick effect, but in the longer run, that would have a very corrosive impact on the U.S. economy because, of course, rates would have to stay higher longer to control those expectations.
Well, that's Christopher Condon there. For more, let's bring our M-Life strategist, Mark Granfield. And Mark, the market has sort of higher expectations than certainly most economists of imminent Fed easing. How does this play out, do you think, given that we're not expecting a move this time, but perhaps some signalling and certainly watchfulness given the politicisation aspect that we've been seeing?
Yeah, exactly. That's what traders are really looking at here. For all those things that Chris was saying there, he's absolutely right about the influences on how the Fed decision-making process will happen, particularly towards the September decision. But traders are they're also here pricing for a shadow Fed outcome as well. So whatever messaging we get from the Fed statement, whatever Jerome Powell says in the press conference, what traders are also betting on here is that we get a deluge of external voices trying to pressurize the Fed to lower interest rates as soon as possible. And that is why you're seeing such a rally in US Treasuries last night. That's why you see the curve flattening. They're also playing into the quarterly refunding announcement, which is coming as well. But they're very much, the market is starting to get influenced by the sheer weight of voices which are coming from outside the Fed and are trying to influence the market into thinking that interest rates are coming down, even if the absolute levels of the data don't really justify an immediate interest rate cut. It seems rather strange when you think that the S&P 500 is at record high levels. Investors seem to be very confident in the state of the US economy, and yet we actually have people expecting that the Fed will lower interest rates again this year, and there's going to be a lot of people, including probably President Trump, saying that needs to be a very quick occurrence as well. So it's a situation that traders haven't really had to deal with very much in the past. They can usually look at the Fed chairman and the people close to him for guidance. This time, they have to widen their spectrum a lot, and they have to look to see where the other influences are coming from. And at the moment, those influences are very clearly looking for a quick rate cut.
So could we see a sharp repricing of those risks, especially the Fed's trajectory, given all of the variables right now? And what would that mean when it comes to market shock?
Well, we have to take into account as well the quarterly refunding. And if, as people are thinking, that Scott Bessent has been saying he wants to shift the funding a lot towards the short term, to Treasury bills, the very short-dated stuff that expires within 1 year, probably around the 6-month and maybe even the 9-month maturities. If he does shift the funding to that end of the curve, that means there's a lot more room for people to pick up the yield advantage in the 5-year, 7-year, 10-year sector of the curve, maybe even a bit further out as well. So that's also what people are counting on as well, is the fact that you have inflation stabilizing nicely at slightly lower levels. There's real yields to pick up if you go for duration down the curve. There's uncertainty over what tariffs will do, how long they would last, how big the impact will be. But more importantly, from a trader's point of view, is where is the supply going to be? Well, if most of it is going to shift to Treasury bills, that makes long-term bonds a lot more attractive than they were before, because you know there won't be as many of them around. There'll still be new issues, there'll be refunding, but there won't be the weight of all that supply will be shifting to a much shorter end of the curve. That means generally a flattening, a ball flattening, as more people shift their duration. There's other external risks, possibility that the rating agencies won't like the fact that the fiscal deficit is widening in America, but that's more of a medium to long-term picture. For now, traders and investors are very concerned about what end of the curve is going to fund and how much pressure can be exposed on the Fed to push those rates down and get the next rate cut in.
Our MLive strategist Mark Cranfield there with the latest on how markets are pricing in the Fed and, of course, all of the eco data and trade headlines as well. We have more ahead. This is Bloomberg.
This is the Asia Trade. Let's get you caught up with some of the corporate headlines that we're following. Bloomberg's been told that ARM-backed chipmaker Ambig has raised $96 million in an upsized IPO. A source says the company sold 4 million shares for $24 each. At the IPO price, Ambig would command a market value of over $423 million based on the outstanding shares listed in its SEC filings. Starbucks shares rose in late trade despite third-quarter sales and profit missing expectations. Investors focused instead on green shoots in the earnings release, including the first sales gain in China since the end of 2022. Nicole told the earnings call more than 20 parties are interested in its China business, but the company wants to retain a meaningful stake. Gucci sales plunged in the second quarter as shoppers turned away from parent Kering's biggest brand. The 25% decline at the Italian label matched analyst estimates. Gucci's new artistic director has yet to unveil his debut collection after his predecessor lasted just 2 years in the job. More ahead on the Asia Trade. This is Bloomberg. Nations are racing to complete trade talks with the US ahead of the Friday deadline for higher tariff rates. The US and China will continue these negotiations over maintaining a tariff truce before it expires in 2 weeks. Any extension ultimately to be decided by President Trump. South Korean Finance Minister Koo Yoon-cho is set to meet with the Treasury Secretary Scott Bessent as well after the delegation held talks with Commerce Secretary Lutnick. Meanwhile, India and Taiwan also racing to the finish line after being locked in negotiations with the US for months now. The IMF is now warning that the world economy will keep weakening and remain vulnerable to trade shocks, even though it is still showing some resilience to Donald Trump's tariffs. Let's talk more about this with Paul Donovan, Chief Economist at UBS Global Wealth Management. Paul, really great to have you with us in Sydney. But has the resilience in the data surprised you, or is it just a result of sort of front-loading before it all hits in the coming months?
It's not a surprise. The impatience of people to see the tariffs in the numbers, I think, is actually a little surprising. It takes time. So there's two things here. Firstly, any goods that were already on board ship heading off to the United States on the 9th of April, they're not subject to tariff. So that means some of the stuff that's being unloaded from Asia in late May and June, that's still not subject to tariff. And then when you get from the port to the shopping basket of the consumer, you've got another 3 months on average. So you're not expecting to see the full effects of these tariffs showing up. The consumer isn't paying the tax until June at the very earliest. And frankly, with the April tariffs, that's probably not going to be fully visible until September. And with the August taxes that Trump's putting on consumers, they're not going to be paid until probably January of next year. So it's a staggered effect. But in the details of the data, we are seeing this start to come through.
And it sounds like it could be sort of a holiday season hit that we're seeing as well. But what about the stickiness and the longevity of tariffs? Is that something that in the longer term concerns you more?
Well, so this is the great unknown. It's the unknown for economists. It's the unknown for the Fed. It's not the first round effects. The first round effects are nice and simple to calculate. Basically, this is going to add about 1.5 percentage points to US inflation. That's effectively the sales tax that the tariffs are likely to represent. The question is the second round effects. Do we see US manufacturers raising their prices because they're facing less price competition from foreign competitors? Do we see US retailers going into profit-led inflation and using this tariff story as a convenient cover to sneak in a bit more profit margin and a bit higher prices? And the more you get those second round effects, the longer the negative impact of the trade taxes is going to weigh on the US consumer.
Does it mean that it makes sense for the Federal Reserve to be cutting rates now in order to preempt that impact?
Well, this is a great problem. I'm not somebody who has a great deal of support for Fed Chair Powell, I have to say. But nevertheless, I do have quite a bit of sympathy for him at the moment because he's in a really difficult position that we don't know how big the second round effects are going to be in total. We don't even know, actually, how big the directive effects of the tariffs are going to be because, firstly, we don't know what all of the trade taxes are going to be, and secondly, we don't know if they're going to survive the court reviews. And, there may will be some dialing back of these taxes as the courts reject them. So it's a lot of uncertainty there. And the wait-and-see approach is basically, I think, saying, well, look, if the economy is going to slow down, and it almost certainly is going to weaken significantly as we go into the second half, should we be cutting rates now, or should we wait to see how bad the damage is going to be? And that's the great uncertainty. So the Fed is in wait-and-see mode, I think justifiably at the moment. I think they'll cut probably 1% over the course of the next 12 months. But when they start that process, that's quite uncertain. Do they cut in September, or do they kick it into the fourth quarter? That's uncertain because the data's uncertain, the tariffs are uncertain. Uncertainty is the hallmark of the current administration in the States.
And the jobs data is one that we're really watching closely, that the Fed is referring to when it comes to also economic fragility, right? What are you seeing in the labor market?
So fragile is exactly the right word, I think, there, because what's going on is the labour market is clearly experiencing some stress because in this climate of uncertainty, companies are refusing to hire. They're not firing workers. If you've got a job, your job is probably safe, but they're not keen to go out and take on new labour because, who knows what the next 12 months is going to bring. And so as a result, we're not seeing job vacancies be particularly strong. We're not seeing that recruitment. Now, that's negative, but it's not disastrous. It's negative because obviously the labour market is weakening. If you're somebody leaving university, you're going to struggle to find work. On the other hand, 21-year-olds aren't that important as consumers. It's the middle-aged people like me who are actually the bigger consumers overall. So, it's what I'm doing, not what my 21-year-old niece is doing that is actually going to matter to economic performance.
So.
Well, no, fortunately we haven't gone down that route, but the TikTok shop does get more of her income than it should. But, that's the pattern that we're going to be looking for. So the Fed is going to be very, very focused on the labour market. Unfortunately, the labour market data is not very good quality, and that's where one of the risks of policy error comes in, not because Powell is more incompetent than normal, but because the data gives a misleading signal and is corrected in revision. That's where the real risk lies, I think.
Speaking of Labubu's, how are you viewing the US-China at the moment? I mean, is this sort of the instinct is to kick the can down the road for another 90 days because this is obviously the hardest decision, the hardest tariff negotiation to have?
I think that is very much the case. And so I think there will be an inclination to, to extend and to try and push this further out. And one of the things about the China trade, of course, is that the China trade is likely to be quite visible to US consumers. They're going to notice when the trade tax comes in on China's products because these are things that they do buy a bit more frequently or they're obsessing about. They're smaller items. It's not steel so much. Steel is not something you don't go out and buy an ingot of steel on a Saturday morning, do you? But you might go out and think, oh, I need a new toaster or I need a new kettle or I need a Labubu. Nobody needs a Labubu, but, that sort of thing. You're going out to spend on a frequent basis. You notice the price increases a bit more there.
Pop Mart needs to start dropping
Paul Donovan,
steel.
Really good to have you with
commodities.
Our chief economist at UBS Global Wealth Management with all that conversation on the economy and the Labubus as well. Good to have you with us because we continue to talk about trade and, of course, those tariff shocks still front of mind for the IMF, which has updated its global growth forecast for this year to 3%. While there's a slight improvement from April, it's still a slowdown from the 3.3% expansion seen last year. The IMF chief economist Pierre-Olivier has told us what they're watching.
We are seeing a modest upwards revision in our growth projection compared to April. But April, when we had our last round, was really at a point where the tariffs that were announced were very elevated on a number of countries. And so some of the upwards revision we have, some of the upgrade, is on the back of the modest easing of trade tensions. So that's the glass half full. The glass half empty is that even with this modest easing, the tariffs are here, and the tariffs are sizable. We are expecting tariffs of the order of 17%, sort of the average tariff of the U.S. on the rest of the world. We were at levels that were less than 3% when we're as of last year. So very sizable increase in the level of tariffs. And so when you compare where we are now compared to where we were expecting to be before tariffs were announced in early April, then growth is actually revised down. Now, where is it going to go? Well, we're here. The important thing to keep in mind is medium-term growth has been relatively weak in the recent years, and it's expected to continue being weak. We have much lower long-term, medium-term growth than we used to have, let's say, 10, 15 years ago. And so that's a concern here, is that the tariffs are actually going to add to that tepid, mediocre medium-term growth and may not necessarily be reverted anytime soon.
Let's talk specifically about the U.S. because you raised your GDP outlook for 2025 to 1.9% and then a very slight acceleration to 2% growth in 2026. And it feels like with every important economic release that we get, we take out our magnifying glass and we try to find tariffs and trade policy somewhere in those releases. And you think about the U.S. economy specifically, it feels like the labor market is holding up. It feels like inflation really has remained under control. But taking a look at the numbers that you put out this morning, it sounds like where we could see the impact is just in overall robustness and overall growth of this economy.
Yeah, so we're seeing a slight uptick in growth for the U.S. in 2025, 1.9%. Some of that, again, reflects the fact that the tariffs are not as bad as they were expected back in April. That is helping a little bit. What has helped also the U.S. economy is an easing of financial conditions. Equity markets have been doing really well and have more than recovered since the April, first few weeks of April. When we're seeing also a depreciation of the U.S. dollar, that depreciation of the U.S. dollar is helping amplify, in effect, the tariff shock, because it's making foreign goods more expensive, both because in their own currency they are now becoming more expensive when you convert that into dollars, and also because they're facing the tariff. So it's amplifying the tariff shock, and it's making U.S. goods more competitive. So that is also helping a little bit. But then the other thing that you have is, of course, the budget bill that was just recently passed. That is going to have a modest expansionary effect on the U.S. economy, especially in 2026. That's behind the upward revision we have to 2% for next year.
IMF Chief Economist Pierre-Olivier just there speaking with our colleague Katie Greenfeld. Some of the stories that we're following today: Blackstone has confirmed that a top executive in its real estate business was killed in yesterday's shooting at its Manhattan headquarters. Wesley LePantner was the CEO of Blackstone REIT and a 43-year-old mother of two. She was among 4 people killed in the shooting, including a police officer and a security guard. Law enforcement officials say the gunman was targeting the National Football League headquarters in the same building, but went to the wrong floor. Shanghai is bracing for heavy rain a day after flooding killed at least 30 people in Beijing and cut power to villages. Storm Komei is expected to make landfall around China's financial capital on Wednesday, with hundreds of flights likely to be cancelled. State media say the torrential downpour that soaked Beijing on Monday forced more than 60,000 people to leave their homes.
And just an alert on the Bloomberg, and magnitude 8 earthquake has hit the Russia Far East city of Petropavlovsky-Kamchatsky. This is 131 kilometers southeast of the coastal city. Pacific Tsunami Warning Center has now warned that there could be some possible tsunami waves along some coasts of not only Russia, but also Japan. There's also tsunami watch issued for the state of Hawaii. We have more ahead. This is Bloomberg. Take a look at President Trump right now, landing at the White House. This is, of course, after his trip to Scotland, where he had conversations with global leaders, including on those ongoing trade negotiations. We know that in Stockholm already, the China and the U.S. Delegations have been having conversations for the 3rd round of trade negotiations in less than 3 months. We're still awaiting for any more details on those conversations, as President Trump has also hinted about tariffs on India from 20 to 25%. But of course, Heidi, we continue to watch all of the ramifications for the broader markets.
That's right, including commodities trading, right? We are seeing sort of some gains being held on when it comes to crude trading at the moment, although at the moment New York crude looking pretty flat, but still we're keeping to the biggest gains in about 6 weeks after Trump reiterated that he could impose additional economic sanctions and penalties on Russia unless that truce with Ukraine is reached. We saw trading of WTI near around $69 a barrel, and that's sort of still sitting there at the moment, with Brent settling above $72 a barrel. Watching copper there as well, up at just about 0.5%, and also gold steadying as we kind of clear the decks for the Fed and trade talks. We've seen some benefits to iron ore as well, given that optimism over the extension of a trade truce with China. Well, speaking of, Rio Tinto reporting first half results later today, with profit and dividend expected to fall, partly due to the impact of US tariffs. Bloomberg's Paul Allen joins us now with more. So what are we likely to hear today?
The underlying profit consensus around that, about $5.17 billion. That's about $600 million less on the year. Interim dividend also seen slipping. That's expected to be about $156, down from $177. And there's a bunch of factors behind this. The most headline-grabbing and exciting one, of course, is, well, the impact of tariffs, which has been a drag. Rio Tinto's got a large aluminium business in Canada. That's obviously been impacted. As to how much, we will find out. Rio did recently say the cost was about $300 million in the first half, although that was offset by higher prices for aluminium as well. And it's a similar story for copper as well. Rio produces copper both inside the US and elsewhere in the rest of the world, so we'll get a little bit more detail on that. Also a drag, there was a large lithium acquisition earlier this year of Haidi lithium. That was $6.7 billion. Lithium prices have been weak, so we're likely to see a drag and perhaps an addition to net debt there as well. Iron ore prices, as you mentioned there, have held up pretty well, still above $90 per tonne for the entire half, although, bad weather in Western Australia. There's been a bad cyclone season. That's been affecting shipments and costs as well, so we may see some impact there. So put it all together, it's going to be a slightly weaker half.
There's also a new CEO coming on board.
Yeah, Simon Trott takes the helm August 25, I believe, so just a few weeks away. So today's announcement's also going to be watched closely for clues about what the Simon Trott era might bring. So far, he's expressed a desire to simplify the organisation, streamline the business as well. One of his key tariffs jobs, let's see, Freudian slip, right? Tariffs. It's going to be managing the impact of that, He has been speaking in local media as well, saying that, look, he's committing to the Pilbara. because there's been some questions about the viability of Western Australian iron ore resources going forward. But he says, look, Rio's going to be there for at least the next 80 years, and it's going to be spending about $13 billion on plant, equipment and expansion as well.
Bloomberg's Paul Allen there with the latest. As we follow also another company here in Japan, we'll be watching Nissan at the open. We're expecting it to post a substantial operating loss. Of course, it's already signaled weak sales, inflation, higher tariffs, and a stronger yen have hit the company. For more, Bloomberg's earnings specialist Rena Sasaki joins us now. And Rena, we have seen Nissan on the spotlight given its massive restructuring. What are we expecting to hear today?
Yes, the first quarter is shaping up as a litmus test for Nissan's turnaround, and the company withheld fiscal year guidance back in May after a net loss of 671 billion yen, one of the largest in its history, and the consensus now points to another net loss of 332 billion yen this year. For the first quarter results today, Bloomberg Intelligence projects a operating loss of 200 billion yen, driven by demand softness, stronger yen, and residual tariff pressures, despite some release from the U.S. and U.S.-Japan trade agreement. And importantly, Nissan's internal forecast calls for the break-even operating profit, excluding tariffs, but that's before the projected tariff impact of 450 billion yen. So investors will be watching for signals that the restructuring 20,000 job cuts and consolidation from 17 plants to 10 is starting to reflect in its cost lines. But at this stage, the first quarter is more likely to confirm the scale of the challenge rather than the signal of an inflection point.
We have seen bond sales from Nissan as well. I mean, they've raised a lot of money. How much runway does Nissan have financially?
Yes, so Nissan extended the runway but has not removed its headwinds. The Nissan raised 800 billion yen, 200 billion in convertible bonds, and 600 billion in straight notes. That helped plug the liquidity gap last year, the last year's loss, and offers some balance sheet relief. But still, Bloomberg Intelligence highlights that the first quarter will likely show continuous pressures with operating losses projected around 200 billion yen. The convertibles also introduce dilution risk if share price supports doesn't materialize. And what's missing here is forward visibility. The decisions to withhold the fiscal year guidance speaks to the depth of Nissan's operating vulnerability. So the market participants will be watching for the commentary around tariff countermeasures and a working capital burn in this quarter's release.
What kind of signals are we getting from sales and production plans globally, particularly when it comes to key markets like the US and like China?
Yes. So the first quarter volume trends paint a weak picture for Nissan so far. The company's April to June retail unit sales fell 11% in Japan, 6% in the US, and 8% in China. That's against a backdrop of heightened FX sensitivity and an elevated material cost. And on the production side, the Nissan is actively retreating. Earlier this month, the company said it would shutter its flagship domestic plant by March 2028, consolidating output to Kyushu, south of Japan. The closures are already planned in Oppa, Japan, India, Argentina, and Kyodo News recently reported that the two Mexico plants may be on the table, though Nissan hasn't confirmed the further cuts. So for the first quarter, the key read-through will be whether the cost resets are gaining traction fast enough to counter lower demand and macro friction, or if the further guidance repression becomes the norm.
Bloomberg earnings specialist Rena Sasaki there. We have more ahead. This is Bloomberg. Keep an eye on shares of Chinese AI firm iFlytek when trading starts in Shenzhen. The stock has been under pressure this year, bucking a rally in Chinese tech triggered by optimism around DeepSeek. Speaking to us exclusively in Shanghai, CFO Duan Dawei told us why he thinks this isn't a cause for concern.
If you're talking about the price of shares, from my experience, the entrepreneurs should not keep their eyes on the share markets every day and every minute. They should care about the customers, care about product, care about technology.
What have been the headwinds that you face as a company?
The short term, a lot of, for example, maybe currently the macroeconomy also has some pressure, and also the trend of the technology, also the competition also very tight. So a lot of short-term factors. We need to notice those short-term factors, but we also, more important, we need to focus on the long-term factors.
iFlytek is now looking into international markets, which I understand you are also responsible for looking after as well. Which markets are you prioritizing in particular?
It's hard to say which market is the priority for our target, because in current stage, we think that artificial intelligence, the industry, is still not mature.
Which countries, though, are you looking toward?
If from the culture and the easy for travels, for transportation, we looking the Asian market is more closer to us. So currently, our business in Korea, in Japan, and also the other Asian countries is increased. But in a long-term run, we think the more and more country, they need to copy some experience and models from China.
We continue to watch the developments around trade. This is the Asia trade. We're counting down to Asia's major market opens. And of course, the U.S.-China negotiations ongoing. The third round of those trade talks in 3 months have finished, but we're still waiting for the details. Heidi, of course, we have heard from President Trump also hint at 20 to 25% tariffs on India as well. And of course, plenty of eco data to watch out for this week.
All of this laying out a very complex situation when it comes to things like the Fed decision, right? How do you sort of make that decision to ease or not to ease? How preemptively when so much is uncertain when it comes to trade? But certainly for this meeting, we're sort of watching the politics angle, right, given how much pressure there's been on Fed Chair Powell.
We are expecting that FOMC policy decision. We're also expecting that BOJ policy decision as well. No change expected on both fronts. Take a look at how Japanese markets are coming online. We, of course, have seen already 3 sessions of pressure for the Nikkei. The Japanese yen still range bound, but what we're following is the JGB space because we had a solid 2-year bond sale, and this as investors were attracted to those bond yields approaching now the highest level since 2008. We do get a very active earnings season. We are expecting Nissan to report. Nomura also topped estimates already. Take a look at how the Kospi is coming online. We have seen the Korean won weaken alongside other major currencies across Asia, with the U.S. dollar continuing to gain ground. But of course, it's the trade negotiations, Heidi, here as well, as we heard that the South Korean delegation has already met with the Commerce Secretary Lutnick in the U.S.
Let's take a look when it comes to how we're setting up in the early part of the trade for Australia. This is a picture as we see the ASX just coming online in that staggered session, a little bit off by about 1/10% there. When it comes to the Aussie dollar, we're holding above that 65 US cent level. And of course, we have seen quite a bit of optimism given the expectations that we will see that prolonged truce being maintained between the US and China on trade. We've seen it benefit the likes of sort of some of these proxy currencies like the Aussie, but also things like iron ore as well. And watching Treasuries, given Shery, as we mentioned, just some of the uncertainties that we're expecting from the Fed at this point.
Yeah, and we are getting, of course, central banks from across the world also announcing their policy decisions. Singapore coming out, maintaining the slope, width, and center of their currency band. And, of course, they use the exchange rate as their main policy tool. We were expecting no change. 14 of 19 economists in a Bloomberg survey had forecast that there wouldn't be a change from the Singapore Central Bank for the first time this year, because they're adopting that wait-and-see approach as we've been talking about those uncertainties around the world. The AMS seeing levels of output falling slightly below potential. GDP growth in Singapore expected to slow in the second half. For 2025 as a whole, though, the output gap is projected to average around 0%, so no change there. The appropriate position to respond to risks being that the AMS has maintained the slope, width, and center of the currency band. When it comes to 2025 CPI, all items inflation, their projection is for 0.5 to 1.5% growth, and the Singapore dollar edging higher as MAS has kept the policy unchanged, but pretty much as expected. This, of course, as we mentioned, ahead of the FOMC decision, ahead of the BOJ decision as well. Let's bring in Raj Singh, multi-asset portfolio manager at Principal Asset Management. Raj, does this make sense where we're seeing all central banks with this wait-and-see approach, holding on, trying to figure out what the really changes in the global economy will be given these trade negotiations and deals that we're seeing now?
Yeah, it does. I think there are a lot of cross currents right now in the market, especially when it comes to the central bank policy. Everybody's trying to assess the impact of these incoming tariffs. Of course, we are hearing a lot more on that front, on trade deal front. But then these tariffs have to work out their ways in economy, both on the activity side and inflation side. So it's no surprise that many central banks are deciding to take this wait-and-see approach to see how these works out in the real economy.
When are we expecting that to start hitting the real economy and these adjustments by central banks, especially the Fed, to start taking place? Because, of course, we have seen those expectations growing of a cut this year, but at the same time, the Fed has been pretty data dependent.
Yeah, I think for tonight's meeting for Fed, we think it's going to be a normal placeholder where Fed is going to reiterate their wait-and-see approach. But the two things we are watching is whether Chair Powell really comments on easing uncertainty, given that we have heard about a few of the trade deals in last week or so. So that will be important, and that will be taken as a dovish signal. The other thing, apart from the rate cuts, we will be looking for is, and there can be some positive surprises on the balance sheet. So apart from the rate decision, it will be also important to see where there are any cues on ending this QT pace, which Fed is having currently, especially given there's going to be a big supply of bills coming in next 3 months or so from Treasuries to increase their Treasury general account balance.
Raj, how do you invest around the policy uncertainty at this point?
Yeah, so I would say that clearly, given some of the trade deals announced, market has taken a comfort by looking at getting some clarity on the tariff rates. However, this trade uncertainty is going to be the feature of economic backdrop for some time. And what you have to do in that is basically you have to look beyond the headlines. Definitely, the market will be paying a lot of attention. One big question for us will be who is really paying for this tariff. Is it corporates? Is it consumer? Is it some of the ex-US government? So that will be a big cushion for markets. But beyond that, you have to look at the fundamentals. When we look at the US economy so far, it's holding quite well. We have seen some positive data from China economy. And moving on to the corporate fundamentals, especially in the US, the corporate fundamentals are looking quite good. The earnings season has been really, really good in US, where more than 80% of the companies are beating expectations, especially these US large cap tech companies. So we really like these US large cap tech companies where the fundamentals are solid. They have quality earning growth coming up, and they have dominant market position, and they are in certain way slightly, I would say, immune or safe from these trade noise we are seeing. So having this quality companies in your portfolios can be a good strategy in this environment.
You also like tech in China.
We do, yeah. So we think that's AI theme, which has been after a pause coming back. It's going to stay with us for quite some time. And this tech is going to be benefiting from this tailwind, whether it's China, whether it's in US, and some of other Asian economies like Taiwan, Korea, they're going to benefit from this tailwind as well. So we think that this theme is going to stay with us. These are the companies which can really benefit and increase their earnings. So we like tech across the board, not only in the US, but in China, in Taiwan, in Korea.
Raj Singh, good to have you with us, multi-asset portfolio manager at Principal Asset Management, on a very busy week of not only central bank policy decisions and trade headlines, but of course earnings as well. We can see Nomura under a little bit of pressure despite the fact that they top profit estimates. They're riding the equity trading boom that fueled earnings for other Wall Street banks, even though their bond desks did struggle a little bit during the heightened market volatility. Net income, though, did rise 52% from a year earlier. This would be the sixth straight quarter of earnings growth. Take a look at also how ANA is trading at the moment, because we saw operating income for the first quarter that beat the average analyst estimate, but it's still downside of more than 3% as we continue to see some of these sectors on the Nikkei weigh the broader index. We're talking about healthcare, consumer discretionary stocks as well, and broader Japanese stocks to the downside. This is Bloomberg.
We don't want to decouple. We just need to de-risk with certain strategic industries, whether it's the rare earths, semiconductors, medicines, and we talked about what we could do together to get into balance within the relationships.
Treasury Secretary Scott Bessent there speaking after 2 days of meetings with Chinese officials in Stockholm. Let's bring our China correspondent Min Min Lo for the latest. So what is the latest, I guess, in terms of what decisions and when they'll be made on potentially the extension of this trade truce?
Yeah, so the two sides met for 2 days and there has been no deal. Scott Bessent saying that the final decision as to whether or not to extend that trade truce will lie with President Trump. And he said that there are still a couple of technical details to be worked out. But both sides so far has made a lot of positive signals about this meeting, saying that the talks were productive, were candid and wide-ranging. Of course, there has been many issues on the table, and at the heart of this discussion is rare earths. The U.S. wants assurance that rare earths will continue flowing into the U.S. They got that reassurance there. Jamieson Greer saying he never wants to talk about rare earths again, and as far as he's concerned, that case is closed. He was also asked about the Section 232 investigation into certain sectors like semiconductors, pharmaceuticals. He says that China wants some updates on that front, but the U.S. simply says that the announcements will come and there will be no exceptions or exemptions made for any countries that will be applied universally. Russian oil or Chinese purchases of Russian oil has also been an issue, and Scott Bessent said in the press conference that he had warned China about potential secondary sanctions. We know that Trump has been putting this ultimatum on Putin, potentially 100% tariffs on countries that buy Russian oil, and this is something that is particularly tricky for China, given that Russia is their largest exporter of or importer of, or rather largest source of crude oil. And according to Scott Bessent, China does have concerns. They have said that they will protect their energy sovereignty, but that is something that has been left open. Scott Bessent saying that it's up to China if they choose to buy and choose to continue to pay the 100% tariff if that were to be imposed later on. So still some details to be worked out, but overall both sides appearing to signal that things were very productive. Potentially, the hope is still there that the trade truce would be extended.
In order not to derail these conversations, of course, we saw that the U.S. was not allowing the Taiwanese president to make a stopover in the United States on his diplomatic trip. We have heard about potential sort of tariff levels when it comes to Taiwan. What else do we know on those conversations?
Yes, Taiwan is also seeking to reach a trade deal with the United States to lower the 32% tariffs on their goods. But so far, not a lot of progress on that front. As you can tell, when the U.S. failed to greenlight this trip by President Ching-te to the U.S., it appears that the U.S. is prioritizing, obviously, China over Taiwan. That's already raising some alarm bells about, what this means. Should a conflict happen in the Taiwan Strait, is the U.S. going to condone Chinese actions to unify with Taiwan? There has been, in the absence of all these signals as to the details of the trade framework that U.S. and China will reach, there's been some speculation about whether or not this is going to lead to a grand bargain, perhaps, when President Xi and Trump meet sometime later this year, because Trump has signaled he is going to meet with President Xi sometime before the end of this year. And there's this idea that perhaps Trump still sees the importance of China to a strong U.S. economy, that eventually perhaps both sides will resolve not just the issue on trade, but perhaps even, greater investments in energy and manufacturing, addressing the TikTok issue, perhaps both sides discussing privately about how to resolve the Taiwan issue as well. But of course, don't rule out the possibility of things perhaps escalating further as well before calming down, because the first trade war, it took 2 years to reach that phase 1 trade deal. There's really a lot of uncertainty right now, given the absence of more information about how those trade talks are going.
Yeah, and all of this as we head towards the August 12th deadline. Bloomberg's China correspondent Ming Lo, there another deadline in place, of course, for other countries when it comes to those blanket tariffs by President Trump. He's now saying that India could face tariffs of up to 25%, although the final rate remains undecided. Talks between the two nations continue as they attempt to reach that trade agreement ahead of that deadline of August 1st. Take a listen.
India is preparing to face higher U.S. tariffs between 20 and 25%. Is that what you're tracking, or what do you think the rate will be for India?
They are going to pay 25%.
Yeah, that India is preparing to face higher U.S. tariffs between 20 and 25%.
Yeah, I think so.
Let's bring in Bloomberg senior editor Derek Wallbank. And Derek, we thought that President Trump had a good relationship with Prime Minister Modi, that the India trade deal could be one of the first to actually get agreed upon. What are we hearing now that a potential 25% tariff could be put on India?
Well, Shery, you're quite right. Donald Trump's friends among world leaders, you would certainly put Narendra Modi on that list, probably near the top of that list, right? So that's the first part of that conversation that's in context. Trump and Modi have had warm relations for a very long time, including back into his first term. At the same point, though, any sort of deal with India is going to be one of the most complicated deals that any U.S. president could possibly look to sign. India is a major exporter into the United States. It is a major start point for a lot of supply chains, increasingly so as supply chains have diversified outside of China. We've seen this with a certain amount of technological products, smartphones, etc. So there's a lot going on there when you're talking about an overall trade balance kind of formulation, which this White House is working with. So that's one part. The second part is that India, when talking about trade, it's not just the tariff barriers, it's the non-tariff barriers as well. And so there is a lot of those that happen to be there. So those are two kind of places that we're watching for here. Overall, we have seen a lot of conversation between these two sides. We've seen India offering some things, but also putting down some red lines in terms of some things that they don't want to have put in. And overall, we're waiting for where this top line winds up. 20 to 25% would certainly be higher than India wants. It would not be towards the highest end of some of the threats that Trump has been leveling there. But it's also possible that when you're looking at some of these deals, as we've seen in some of the other places, you may be getting some carve-outs. So it might be 20 to 20% for most products, but then some other things might go at different levels. We're going to have to see what the terms of this are going to be. One important thing to mention, though, about this and all the rest of the trade deals is that we're getting signals from U.S. negotiators that August 1 will not be pushed back, but it also might be temporary. So if some if some rates were levied on August 1, but then talks continued and you got a deal on August 7, you only have 7 days of those those higher tariff rates until you got to whatever the new thing was. So this may not be like if something triggers and snaps in on August 1, that might not be it forever.
Interestingly, we're hearing about these potential secondary sanctions on Russia, and that would obviously have an impact on some of these trading partners like India and China as well, right? What is this new strategy that we're hearing from President Trump to try once again to push for this Ukraine ceasefire?
Well, yeah, and look, anytime that you hear the word secondary sanctions when it's applied to Russia in the context of Ukraine, if you're talking about sanctions that go to people who trade with Russia, you should immediately think China. You should immediately think India, right? There are others, but those are the two major world economies that you should immediately think of. Now, Trump has been keeping his cards a little bit close to the vest in terms of what he exactly wants to do. It's possible that may not be finalized yet, but Trump has been very clear in recent days that he's growing increasingly frustrated with Vladimir Putin, increasingly frustrated about a failure that he sees of the Russian leader to take serious steps towards wanting to end the war in Ukraine that Putin started. Remember, Trump coming into office was much more frustrated with Vladimir Zelensky and with Ukraine than the last administration had been. He's putting a lot of fault onto Ukraine. A lot of that rhetoric has shifted recently, and he's been much more critical of Russia of late. Trump's comments on secondary sanctions did have an effect on oil markets when he said it, when those headlines ran. It remains to be seen exactly what would happen here, but you could imagine scenarios where whatever is constructed could be quite consequential quite quickly, and so far, Moscow has remained entirely unmoved by any of these escalated threats.
Derek Wallbank there, Bloomberg Senior Editor, catching us up with the latest when it comes to these geopolitical developments. Take a look at how European futures are tracking at the moment. This after we saw the previous session, European stocks pairing those gains. We saw some guidance being cut by Novo Nordisk as well. That was obviously a massive story there. We're seeing a little bit of upside there. Also upside trading in the euro as we continue to watch these trade negotiations. More ahead on the Asia trade. This is Bloomberg.
Broad downside for automakers across Japan, with Nissan losing more than 1% in today's session. It could see a further drop in revenue when it reports first quarter earnings today, but the deal to reduce U.S. auto tariffs could help its plans to cut costs and raise funds to rescue its flailing business. Bloomberg Intelligence senior analyst Tatsuo Yoshida joins us now with the latest, and we have seen some signaling about weak sales. So how bad could the numbers be today?
Actually, the big loss is more or less expected. So the company, they themselves said it's going to be a 200 billion operating loss. So seeing the big loss is not going to surprise the market. But more importantly, we are more interested in the outlook or guidance. So like you said, given the tariff has been reduced, how they can improve their earnings. Earlier this year, they said that we are break-even without tariff, but tariff drag our profit as much as 450 billion yen. So now we are expecting how they can shrink that loss.
What are the options then to that front?
Actually, there's not a quick remedy, but trimming the production capacity, that's the things they need to do. But real turnaround takes time because new product is not coming overnight, and the brand is not going to improve overnight either. and more importantly, sales practice. So heavily incentivized sales practice. That is hard to fix in a short time period.
Do they have enough cash?
The raising fund earlier this month, that was a good news. But cost of the money is high. So we analysts are also interested in they can afford to pay that interest cost.
Do we have any indications from Nissan's numbers about the broader Japanese auto sector and what to expect?
Actually, Nissan is kind of exceptions. So Toyota, Honda, and Suzuki, they may report much stronger results, I think.
Especially given the optimism over the auto tariffs of 15%. Bloomberg Intelligence senior analyst Tatsuo Yoshida here with the latest on what to expect from Nissan, as we're, of course, also watching automakers across Japan right now losing ground. Nissan is down more than 1%, but you have the likes of Toyota also losing ground more than almost 2% at the moment. We do have also an alert on the Bloomberg because we continue to follow the latest developments around that earthquake in Russia's Far East. And we're talking about a magnitude 8.7 earthquake southeast of Petropavlovsk, Kamchatsky in Russia's Far East. Now, with the Pacific Tsunami Warning Center saying that they see waves possible along some coasts of Hawaii. Already, we had seen some alerts about possible waves along coast of Russia, but also here in Japan. So a tsunami watch has been issued for the state of Hawaii as we get the latest developments on that earthquake that initially was thought to be around magnitude 8 and has been now revised upwards to 8.7%. In the meantime, broadly in the markets right now, we're really holding steady, range bound for Asian equities, also Japanese stocks. All of this, of course, as we head towards the Bank of Japan policy decision, not to mention the Fed. No change expected on both fronts. This is Bloomberg.
Take a look at how we're tracking. About 30 minutes into the start of major markets coming online here in Asia. Of course, a lot for investors to contend with. We are seeing pretty flat trading there when it comes to Japanese equities. A little bit of upside for Korean stocks and really sideways trading here in Australia as well ahead of the Fed's policy decision. We've seen sort of modest updates of progress in US-China trade talks, and that's really failed to lift its sentiment as well. We're also watching geopolitics and the impact that we see on oil prices with this new deadline extended by President Trump for this Russia-Ukraine ceasefire as well, with the threat of sort of additional penalties and secondary sanctions. So there is a lot going on. In addition, we're seeing these economic projections as well, with the IMF saying that global growth remains fragile and exposed to trade shocks despite signs of resilience to Trump-era tariffs. The lender now sees 2025 growth at 3%. That's down slightly from last year's 3.3%, but an upgrade from its April forecast. And its chief economist, Pierre-Olivier, has told us that the tariff effects may be slow to revert.
Medium-term growth has been relatively weak in the recent years, and it's expected to continue being weak. We have much lower long-term, medium-term growth than we used to have, let's say, 10, 15 years ago. And so that's a concern here, is that the tariffs are actually going to add to that tepid, mediocre medium-term growth and may not necessarily be reverted anytime soon.
Let's bring in for some analysis. Our next guest, Haidi Crebo-Rediker, is a senior fellow at the Council on Foreign Relations. And there's a sort of race to the finish line before this next deadline, right? Have you been encouraged by the progress that we've seen so far?
Yeah, I mean, the clock is ticking for sure. But I think, we have seen some quote-unquote wins with UK, with EU, Japan, and China's in the works. There are, I think, there's a devil in the details, which we really haven't seen a lot of the details from all of these quote-unquote agreements. But I think it's very positive that we've sort of reached a level where you sort of landed in the 15% zone for both Japan and the EU. I think, we still have some outstanding big economies and big trading partners that have not concluded negotiations yet. And I think those are ones that are on my radar.
We also don't have a great deal of detail in terms of what these significant deals, as President Trump would call them, have, be it with the EU or Japan. Does that concern you in terms of the lack of specifics that we've seen so far?
Well, I think, specifically on the investment side, I mean, you have some very, very big numbers that have been announced. And I would just, when I think about the $550 billion for Japan, it didn't take long for the sort of the confusion between what the takeaways were from both the U.S. and the Japanese side. I mean, the Japanese said that it's not a big fiscal check that Japan is writing to the United States, sort of handing it over, U.S. government or U.S. invests, and then they get a 90-10 split in favor of the U.S. I think the Japanese were thinking much more of an envelope where you have, loans and loan guarantees, but private companies make those decisions. And in the same way that the U.S. works, you can't tell the U.S. companies where to invest outside of the U.S. And so I think there's a lot of understanding of where both are really taking away to come. I think the Secretary of Commerce today said that with regard to the EU as well.
Who will keep tabs on who are the winners and losers of these deals? Because, as you said, I mean, the tariff impact on U.S. consumers will probably come later on. But at what point will, within the Trump administration in the U.S., start to realize what the broader implications will be, given all of these different tariff deals that, as you said, where the details are really not clear, especially on where all of this money is supposed to come from?
So I think, President Trump is going to be the one who's keeping the tabs on everybody, everything, every country. And I think that's one of the considerations that countries have when they're negotiating with him is, are these deals going to hold, even the ones that we've agreed to? When it comes to what some of your earlier guests were talking about, the impact on consumers, on the economy, the impact on where you're going to see this actually play out, I think it's going to be more into the beginning of next year, and that has a huge implication for the Fed and what it does. Who's going to bear the brunt of? You still have, if you have 15 to 20% or 25%, possibly in the case of India, if you have those tariffs, it's still meaningful, and somebody's going to eat that cost. It's either the exporting country/company, the consumer, or the company in between eating the cost. So it all depends on where it plays out, who takes what where, but it's got to be eaten by somewhere. And it seems right now, since those tariffs are being collected as revenue in the U.S., that somebody is eating them somewhere.
When you're watching the implications of all of these trade negotiations, especially when it comes to U.S. positioning, are there going to be long-term effects on American diplomacy? Because at this point, it seems everything is on the table and it's not at the same time. A lot of the sectoral tariffs, especially steel and aluminum, were linked to national security. We're hearing from the Financial Times as well that some of those tech export restrictions to China have been paused because they wanted a good conversation in Stockholm. So you first linked national security to trade, and now you're putting it on the table. So does this, in the long run, harm America's stance when it comes to negotiating with different countries, even beyond the Trump administration?
So it absolutely does. I think, you have, in all of these negotiations, really, everything's been on the table. And so we've seen that play out in different scenarios, but especially for those countries where they have a dependency on the United States for security and defense. So that has loomed largely in the background, and even larger, for example, when it comes to the EU and the UK, where they really want to make sure that the U.S. is tied into NATO and to continuing to support the Ukrainians in their battle to defend their sovereignty.
Heidi, you're also sort of amusing in terms of what these ongoing talks mean for some of the traditional allies, including Australia, right? We've seen sort of some appeasement when it comes to the beef situation. Is that going to be enough? And does the fact that there is security alliance, there's traditional defense alliance that goes back, many, many generations, does that actually help at all in terms of having any leverage on trade?
So I think, it obviously helps with the mood music, But while I think it's very positive that the Australians moved to roll back some of the restrictions on American beef imports, I am worried that it might not be enough. I think, they are a member of Five Eyes in the intelligence community. They are a member of AUKUS. They are a member of the Quad. But I do think that they may get a surprise. They have we've had a free trade agreement with Australia after years of having very low to no tariffs. We have 24 billion of Australian goods that are sold every year into the U.S., and they were subject to the lowest rate. So if they end up getting the 15% across the board because they haven't written a big check, then I think that'll be quite a shock for them, and I think it'll damage the relationship more than I think the U.S. would like to imagine right now. I think the play so far that Trump has himself said is that in the case of Japan and the EU, they had to pay down their tariffs to get to that 15%. And I do think that President Trump is looking to announce big checks for investment into the U.S., regardless of what country is on the other side. I think that goes for South Korea as well. So I think, whatever that deal is that Australia can put together, I think it needs to be more than beef. And I think it needs to be in a very short time frame.
Heidi Crebo-Rediker, good to have you with us, Senior Fellow at the Council on Foreign Relations, of course, as we head towards those tariff deadlines August 1st for most countries. Other stories that we're following, UK Prime Minister Keir Starmer says Britain will recognize Palestine in September unless Israel agrees to a ceasefire with Hamas. He says Israel must also commit to a peace process that would result in a Palestinian state. The decision follows similar plans from France and signals a sharp diplomatic shift. Israel condemned the announcement, calling it a reward for terrorism. Blackstone has confirmed that a top executive in its real estate business was killed in yesterday's shooting at its Manhattan headquarters. Wesley LePatner was CEO of Blackstone REIT and a 43-year-old mother of two. She was among 4 people killed in the shooting, including a police officer and a security guard. Law enforcement officials say the gunman was targeting the National Football League headquarters in the same building, but went to the wrong floor. We have more ahead. This is Bloomberg. Construction officially began this month for China's $167 billion mega dam in Tibet. It's set to become one of the biggest infrastructure projects in history and a legacy-defining gamble for President Xi as he tries to revive China's slowing economy. Bloomberg climate reporter Aaron Clark joins us now from Singapore for more on today's Big Take. Aaron, so what can you tell us about the broader impact from this dam?
Yeah, this is a prestige mega project in China. There's really economic and climate objectives that are main goals from this. It's also a geopolitical tool for Chinese President Xi Jinping, who wants to exert influence in the rest of the region of Tibet through water control. When we just talk about the materials involved, it's such a big project. This is going to use 60 times the amount of cement as the Hoover Dam in the U.S. If you built a 2-lane highway with all the cement that's going to be used in this project, it would circle the Earth 5 times. From an electricity perspective, the numbers are also big. It's going to have a capacity of about 70 gigawatts. It's anticipated to generate 300 terawatt hours of electricity a year. That's roughly equivalent to the amount of electricity consumed in the UK each year. And the climate impact is significant as well. China still relies on coal-generated power for more than half of its electricity. This project could offset about 300 million tons of carbon dioxide a year. That's very significant. However, it's just a fraction of China's total emissions, which were about 13 billion tons of CO2 a year in 2023. It's also important to think about the localized impacts. The Tibetan Plateau, where this is going to be built, is sort of known as the third pole. It holds more ice and snow than any other region except the Arctic and the Antarctic, and so it plays a very very stabilizing role in the climate of South Asia. The area where it's going to be built is also very rich in biodiversity. There's about 150 different fish species in the wider basin, some of which are near extinction. There's snow leopards, there's red panda. So anytime you're building one of the world's largest infrastructure projects in a sort of a fragile place like this, there are going to be larger localized impacts.
It's also a politically restive region, right, as well. Reducing emissions from power generation is going to be critical, obviously, if we want to put a limit on extreme weather events. So we're seeing this sort of playing out when it comes to Shanghai at the moment with the incoming typhoon. Beijing has already had heavy rainfall that's killed a number of people. What do we see in terms of what's driving this flooding?
Yeah, I mean, I think it relates back to the climate and emissions. Like you said, more than 30 people died in Beijing over the last few days. 80,000 people were relocated. Now we see, rains bearing down on Shanghai. I think in some areas they're expecting to get 220 millimeters of water, about 8.7 inches. So there could be significant flooding in Shanghai. This is, the latest in a series of major flooding events around the world. Earlier this month in Texas, more than 130 people died from extreme flooding there. In Pakistan, since June, more than 200 people have died, and this, of course, came after the horrific floods we saw in Valencia and Spain last year, which killed more than 220 people. And I think, when you talk to climate scientists, what they say is that as the Earth warms, the air is actually able to hold more moisture, and so that's why you're seeing more intense rains, which lead to flooding, which lead to of course, fatalities and a lot of damage to infrastructure and economies. I think the concern is that if you don't see a reduction in greenhouse gas emissions, that you'll see patterns like this sort of locked in, and you'll see an accelerated water cycle where these things become more common and more intense.
Bloomberg News climate reporter Aaron Clark there. And we do have breaking news at the moment. Japan has issued a tsunami warning for areas including Tokyo Bay. Just a few minutes ago, of course, we had the 8.7 magnitude earthquake in Petropavlovsk-Kamchatsky in Russia's far east. And since then, we've seen the Pacific Tsunami Warning Center seeing tsunami threats along some coast of Hawaiian Islands. And they had also warned about coasts of Russia and Japan. And now we're seeing Japan upgrading the tsunami warning to around 3 meters that could hit areas including Tokyo Bay. So Heidi, we'll bring you the latest as we get them, but still here in Japan, we're on watch for that tsunami warning.
Shery, in the meantime, the Bloomberg Sustainable Business Summit is underway in Singapore. Nations feeling the impact of climate change through extreme weather events. We'll be hearing from business leaders and investors on their approach to sustainability and green financing. Terminal subscribers can find that on LiveGo. Later on, we'll be speaking with the former Canadian Trade Minister, Mary Ng, for her views on how the Trump trade war is impacting ESG policies in Asia and beyond. More ahead here on the Asia Trade. This is Bloomberg.
We're following Fujitec at the moment, trading down more than 9% in Tokyo trading. We have heard from the Nikkei now reporting that the Swedish investment firm EQT seeking to buy the Japanese elevator maker. EQT planning to launch a tender offer around 5,500 yen to 59.99 for each Fujitec share. We had heard last October that Fujitec was fielding several initial non-binding offers from investment funds. We're now seeing that a downside of more than 9%, as we hear from local media, that EQT seeking to buy the company. Right, and of course it's earnings season. Standard Chartered and HSBC both due to report results. Bloomberg Intelligence says the results will show how the lenders managed to cope with uncertainty on trade and interest rate trajectories. For more, let's bring in breaking news earnings specialist Rachel. So really the geopolitical tensions, trade uncertainty, how these companies fare amid all of this.
Yeah, so definitely that's the biggest thing to look out for HSBC and Standard Chartered earnings, whether or not they are coping well amidst the geopolitical and trade uncertainties as well as any interest rate trajectories. So far, the market's sentiment has been looking strong for both HSBC and Standard Chartered, given that their shares have rallied since the start of the early trade war in April, especially after seeing a slump at the beginning. In terms of, so this also reflects, increasing confidence in both of these banks for their abilities to navigate the current uncertainties going on at the moment. So whether or not that can be reflected in their earnings will be one to look out for as well. So in terms of the second quarter, Standard Chartered is expected to see its wealth management business continuing to be strong and sustaining revenue momentum. And anything for similarly for HSBC, anything on its wealth management business and its cost savings will also be important for its upcoming growth as well.
Are there any sort of common themes to look out for in terms of both sets of earnings?
Yes. So apart from tariff impacts, we're also looking out for comments on U.S.-China relations and anything on China bad loans or provisioning for real estate and investment. So it's also worth looking out for updates on job cuts as well, given that cost savings has been quite a big focus for both of these lenders. And there have been reports previously on job cuts happening or job shifts happening across specific teams. And secondly, any updates on major personnel changes, such as new chairman for HSBC after Mark Tucker announced that he will step down by the end of the year, that will be one to look out for as well. And also, finally, anything on fresh buybacks, amidst this current geopolitical environment will be one weighing on investors' minds as well.
Breaking news earnings specialist Rachel Yeo there, ahead of HSBC and StanChart's numbers, and getting you caught up to date with some of the other corporate headlines that we're following this hour. Bloomberg has learned that Anthropic is nearing a deal to raise as much as $5 billion in a new funding round. Our source tells us the financing is being led by Iconic Capital and may involve other investors, including the Qatar Investment Authority and Singapore's sovereign fund GIC. The move would value the AI startup at $170 billion, fueling its competition with OpenAI and Elon Musk's xAI. Bloomberg's been told that the ARM-backed chipmaker Ambic has raised $96 million in an upsized IPO. A source says the company sold 4 million shares at $24 each. At the IPO price, Ambic would command a market value of over $423 million based on the outstanding shares listed in its SEC filings.
And when trading gets started in Shenzhen, do keep an eye on shares of Chinese AI firm iFlytek. The stock has been under pressure this year, bucking a rally in Chinese tech triggered by optimism around DeepSeek. Speaking to us exclusively in Shanghai, CFO Duan Dawei told us why he thinks this isn't a cause for concern.
If you're talking about the price of shares, from my experience, the entrepreneurs should not keep their eyes on the share markets every day and every minute. They should care about the customers, care about product, care about technology.
What have been the headwinds that you face as a company?
The short term, a lot of, for example, maybe currently the macroeconomy also have some pressure, and also the trend of the technology, also the competition also very tight. So a lot of short-term factors. We need to notice those short-term factors, but we also, more important, we need to focus on the long-term factors.
iFlytek is now looking into international markets, which I understand you are also responsible for looking after as well. Which markets are you prioritizing in particular?
It's hard to say which market is a priority for our target, because in current stage, we think that artificial intelligence, the industry, is still not mature.
Which countries, though, are you looking toward?
If from the culture and the easy for travels, for transportation, we looking the Asian market is more closer to us. So currently, our business in Korea, in Japan, and also the other Asian countries is increased. But in a long-term run, we think the more and more country, they need to copy some experience and models from China.
iFlytek CFO Duan Dawei there speaking exclusively with our tech reporter Annabelle Jewellers in Shanghai. Take a look at what we're watching when it comes to the start of trading across Greater China over the next hour or so. And of course, we're keenly watching for any further developments on the US and China trade front. We had talks in Stockholm and the expectation of potentially the extension of that trade truce. That's it for the Asia trade. This is Bloomberg.